The next corporate levy we're going to discuss is the accumulated earnings tax. And this is kind of like a second shot for the IRS at additional tax. If a company is not a personal holding company, it might still owe accumulated earnings tax. So this is a penalty tax on corporations that don't distribute enough to the shareholders in order to avoid double taxation. It's levied on current year addition to accumulated earnings balance. So it's not levied on all of the accumulated earnings of a corporation, but it is levied on the current year addition to that balance. Taxpayers have to prove why the accumulated earnings does not have a tax avoidance purpose. So it's the taxpayer's obligation to prove that there is a reason to retain earnings inside the corporation. It's going to be levied on earnings not necessary for a valid business purpose, and certain corporate forms are excluded. Those are personal holding companies, corporations exempt from taxation, and S corporations. So obviously personal holding companies are excluded because they have their own test, which we just discussed. So I might owe the personal holding company tax, or I might owe the accumulated earnings tax. I would never owe both. This is going to usually come out of a closely held business because that provides more incentive to accumulate earnings. Examples of a tax avoidance purpose might be a loan to shareholders without a valid business purpose, paying for personal expenses of a shareholder that have no relationship to the business, loans with no reasonable relationship to the conduct of the business, loans to a corporation controlled by the same shareholders as the lending corporation, investments in property or securities unrelated to activities of the corporation, and then insuring against unrealistic hazards. If we get audited, the IRS can come in and reclassify transactions as dividends. The taxpayer can refute the tax avoidance assertion by demonstrating that there is a reason to retain those earnings. So we have to have definite plans. They have to be feasible plans. We have to have subsequent event predictions. So we want to expand. We want to redeem some stock. We have reasonable working capital needs. This is a facts and circumstances inquiry, which means there's no bright line rule, or we can prove it with this Bardell formula, which is a bright line working capital rule. Here's the calculation. Again, I am not concerned that you can do this calculation, but I am concerned that you understand it. And as you'll see, it's very similar to the personal holding company tax calculation. We start with regular taxable income, and we make positive and negative adjustments, and those are the same as the personal holding company calculation. We also get a dividends paid deduction, and then you'll notice we also subtract the accumulated earnings credit. This credit allows a corporation to retain some earnings without being subject to the tax. So corporations are generally allowed to retain $250,000 for C corporations, or the level of earnings necessary for the reasonable needs of the business. So the $250,000 is kind of like a safe harbor. I can accumulate that without explaining why I need to do it. If I want to accumulate more than that, I need to find a way to explain that that's necessary for the reasonable needs of the business. And again, the rate is 20%, just like it was for the personal holding company tax. And that rate is tied to the highest dividend rate for individuals for qualified dividends. All right, so we said that we can retain earnings for working capital, and working capital is the amount of money needed during a normal operating cycle, which is the date from the acquisition of inventory to when the cash is collected from the customer for that inventory. This is a facts and circumstances inquiry, and again, that means there's no bright line rule. So anytime you have a facts and circumstances test, it's heavily litigated because the IRS will argue one thing and you will argue another, and courts generally have to solve it. There's also a formula for working capital that is the safe harbor, the Bardell formula. You don't have to memorize that. I just thought I would show you that it's there. So you work through this formula and you get a working capital requirement, and then this formula will give you the average operating cycle. So the working capital requirement is going to be compared with working capital at the end of the year. If the requirement is greater than the year-end working capital, then the accumulation for excess earnings is not applicable to you. You don't owe a tax on that. But If the working capital requirement is less than the working capital that is accumulated in the corporation, the accumulation is deemed to be unreasonable unless it is refuted by the corporate taxpayer. In each of the following scenarios, indicate why Adobe Corporation's accumulation of earnings might be unreasonable relative to its business needs. Prove one or more arguments the corporation might put forth to support its position that the accumulation is reasonable. Assume Tess owns all the Adobe stock. A. 10 years ago, Adobe established a sinking fund to retire its 10-year notes and has added cash to the fund annually. 6 months ago, the corporation decided to refinance the notes at maturity at a lower interest rate through the issuance of a new series of bonds sold to an insurance company. The sinking fund balance is invested in stocks and commercial paper. A general plan exists to use the balance to purchase operating assets. No definite plans have been established by year end. Okay, so the IRS is probably going to argue the sinking fund is no longer necessary because the debt has been refinanced, and it should be paid out as a dividend. The lack of definite corporate plans at year end regarding the use of funds to purchase operating assets could hurt the company. The corporation, though, might argue that temporary investments in stocks and bonds are not necessarily an indication that an unreasonable accumulation of earnings exists with a tax avoidance motive. They could make the argument that a general plan to purchase operating assets exists at year end, and the corporation is in the process of reviewing those acquisition policies. B. Adobe regularly lends money to Tess at a rate slightly below the rate charged by a commercial bank. Tess has repaid about 20% of these loans. The current balance is $500,000, which approximates 1 year's net income for Adobe. Now remember, Tess is the only shareholder. She owns 100% of Adobe. So the IRS is not going to like this. The IRS agent will likely argue the loans at below market rates serve as a substitute for dividend payments. Their use and size indicates a possible accumulated earnings tax problem and a tax avoidance motive. The agent might also not like the documentation, that there isn't any documentation about the loans, no enforcement of due dates, etc. The corporation might argue, though, that the loans are temporary in nature and were made only because excess funds were available while the corporation waited to carry out other plans that could be documented. A plan for repaying the remaining loans and the use of the amount so received in subsequent business activities might strengthen the corporation's argument. C. Adobe's heavily invested in stocks and bonds. The current market value of its investment is $2 million. The investment portfolio comprises half of Adobe's assets. So again, the IRS is not going to like that. They will argue the corporation's investment suggests it's accumulating earnings, right? The corporate level of investments effectively serve as a substitute for dividend payments and Tess's personal investments, because remember, she's the only shareholder. The corporation should provide plans for using a large portion of the funds to support its operating activities in the near future. D. Tess owns 3 other corporations, which, together with Adobe, form a brother-sister controlled group. Adobe regularly lends funds to Tess's 3 other corporations. Current loans amount to $500,000. The interest rate charged approximates the commercial rate for similar loans. The IRS is going to argue that these loans between members of a controlled group suggest earnings accumulation to benefit Tess. The corporate loans are a substitute for dividend payments, and they are actually her personal loans or additional capital contributions to the other corporations. Corporations might argue the loans are temporary and then provide written evidence of debt and that the note principal has been paid when due. Plans for using the funds to support Adobe's operating activities would strengthen the taxpayer's argument. Adobe might have legitimate business reasons for lending funds to Tess's other corporations. I think that's the most tenuous example we have. That's probably not going to fly with the IRS. So obviously, we want to counsel our corporations to avoid these 2 taxes. We want to avoid the personal holding company tax and avoid the accumulated earnings tax. To avoid the personal holding company tax, we have more bright line rules, so it's easier to avoid the tax. We could change stock ownership, right? We could either concentrate ownership among 6 people, right? More than 5 people, because remember, To be a personal holding company, we have over half of the ownership concentrated in 5 or fewer individuals. So we could spread that out a little bit. We could change the type of income. We could add operating activities, change the type of investment income, or add additional passive income to just kind of lower the amount of personal holding company income in the corporation. We could make dividend distributions because we know that reduces personal holding company income. We can make an S election. We could convert to an S corporation. They are exempt from the tax, but it's not very attractive because at that point the individual tax rates are going to be above the corporate tax rates, and we know that an S corp is a flow through, so that's not very attractive to our shareholders usually. Or we could liquidate the corporation. That also it's going to exempt us from the personal holding company tax, but it's also probably not going to be very attractive to our shareholders because individual tax rates are above the corporate tax rates. And again, we're going to have to pay tax at our individual tax rates upon liquidation. All right, and then finally, or next, avoiding the accumulated earnings tax is not as simple because there's not really a bright line test. So what we're going to have to do is to document that any accumulated earnings are necessary to meet the future capital needs of the business. We want to establish these plans and document these plans each year. We want the plans to be specific and we want to revise them ever so often. If we complete a project, we want to document that. If we abandon a project, we want to delete it from the plan and document why it was abandoned. We also want to document a timetable. And then any transactions that are indicative of unreasonable accumulation should be avoided. And then for the personal holding company tax, the personal holding company, if we are a personal holding company, we file Form 1120 just like other corporations. And to that, we attach Schedule PH. And Schedule PH is going to contain the personal holding company tests. For the accumulated earnings tax, there's no return needed because the accumulated earnings tax is assessed by the IRS after an audit. Parrish is a closely held C corporation. Robert and Kim Parrish own all of its stock. The corporation, now in its second month of operation, expects to earn $200,000 of gross income in the current tax year. This income is expected to consist of approximately 40% dividends, 30% bond interest, and 30% net real estate rentals. Administrative expenses are estimated to be $40,000. What special problems does Parrish Corporation's earning substantial passive income present to you as its CPA? So just at the outset, this looks like a personal holding company because all of the stock is owned by Robert and Kim. So we're over that 50% ownership in 5 or fewer individuals. And then this type of income is passive, right? Dividends, interest, and rentals. So first, we obviously want to know, will this be a personal holding company? And if it's going to incur a personal holding company tax liability, what measures can be taken before year-end to avoid that? So can we pay some dividends? What can we do? Should the corporation make an S election? Would that be beneficial? And the answer to that is probably going to depend on its activities going forward. So this is its first year of operation. If every year of operation it's going to contain a lot of passive activities, we might consider making an S election. And so we said that we could pay dividends to decrease the personal holding company tax. If Parrish lacks sufficient cash to pay those dividends, could we pay a consent dividend to eliminate the cash shortfall? McHale is a C corporation owned by 8 individuals, 3 of whom own 51% of the stock and comprise the board of directors. The corporation operates a successful auto repair parts manufacturing business. It has accumulated $2 million of earnings and profits and expects to accumulate another $300,000 annually. Annual dividends are $30,000. Because Americans retain their vehicles longer than they did 20 years ago, demand for repair parts has been strong for the past 5 years. However, little expansion or replacement of the current plant is projected for 3 to 5 years. Management has invested $200,000 annually in growth stocks. Its current investment portfolio, which is held primarily as protection against a business downturn, is valued at $1.2 million. Loans to shareholder employees currently amount to $400,000. As McHale's tax return preparer, what tax issues should you have your client consider? Okay, so looking at the outset of this, it's probably not a personal holding company because although 3 shareholders own over 50% of the corporation, it doesn't look like there's a lot of passive income coming in here. But we may be concerned with accumulated earnings tax because you can see that we have accumulated a large amount of earnings and profits, $2 million. We're adding to it every year by $300,000. We're only paying $30,000 of dividends. We're not expanding or replacing the current plant, and we're not planning to do that for 3 to 5 years. We're also investing in growth stocks, which don't seem to be related to our business. And we are making loans to shareholder employees of $400,000. So this is going to raise some concerns as the tax preparer that we may owe accumulated earnings tax. So we need to take some steps to reduce its earnings tax exposure. So if we are planning to expand or replace, we should make definite plans, definite documented plans, and put dollars to those plans. If we are not looking to expand, we should consider maybe an S-Corp election or paying out some of these earnings and profits.